Hello and welcome. This is the earnings special on BloombergQuint. We are taking stock of how the third quarter for Infosys has panned out. At this point in time, while I do look at the revenues, they do seem largely in line with street expectations, but the big miss perhaps and a surprise is in their margins. Now, reported margins have come in at around 20.5% against 23.7%, but don't be too startled because there are certain adjustments playing out in this particular aspect. So if you consider the adjusted margins for certain write-offs that the company has taken, that stands at around 22.6%. However, that is still lower than the estimates that we were working with at around 23.5%. Net profit consequently declined around 12.2% on a sequential basis. To take us through the numbers and what we can make of them, we have Vineeta Sharma of Narnolia Financial Advisors joining us, and we also have Harit Shah of Reliance Securities joining us. Harit, thanks for taking the time out. I'm going to come to you first. What have you made of the numbers? There are a lot of mixed trends playing out. What is your initial take?
Yeah, so I think overall, a positive takeaway. The revenue increase in the constant currency guidance is a very good, sign, and it signifies very strong revenue acceleration. And in fact, this quarter itself, on a year-on-year basis, revenue grew by in double digits in constant currency. And secondly, very good deal wins as well. And and I think as far as the margin is concerned, one thing we should also understand that there was a one-time item of depreciation, additional depreciation that they provided for, reduction in value of their erstwhile subsidiaries, Scava and Panaya. I think though they were the subject of much controversy some time ago, but I think that if you adjust for that, the margin is a little bit higher than what it has been reported. So, while admittedly margin pressure, even I think including that there is some amount of margin pressure, but they maintain their margin band. So that is, I think, a positive sign, and it does show that the business is in pretty good hands at the moment.
Right. Harit, there's the other question of the buyback, which has been announced at 800 rupees per share, if I'm not mistaken. The announcement of the price per share is considerably higher than what we were working with. But the buyback amount then it's relatively smaller because we were working with a number of well over 10,000 crores. If I'm not mistaken, the quantum that they're going to put in the buyback is around 8,800 crores thereabouts. What's your take there?
Yes, they've actually done a bit of a combination of buyback and dividends. So they paid out a 4 rupee special dividend, which will amount to 2,000 odd crore of payout and 8,200 odd crore of buyback. So that, totals to an excess of 10,000 crore. So including, the earlier part of the year when they paid out about 2,600 crore, I think, that pretty much, settles the 13,000 crore rupee payout that they were expecting for FY19.
Right.
So yeah, I mean, probably a pure buyback versus buyback and dividend combination may have been a better option, given that dividends are less tax efficient. That is,
sure.
You can argue that.
Sure. Harit, hold that thought. Let me get in Vineeta Sharma of Narnolia as well with us. Vineeta, what is your initial take here? How are you reading the numbers? Because I'm clearly looking at mixed cues.
As far as top line is concerned, there is a 2.7% constant currency top line growth, which is quite encouraging. And I think sales numbers are pretty much in line. Little bit on the front, they have as because of one-off item of 451 crore because of Scava and Panaya, I guess. And if we adjust that, I think the margin is very much well within the range that the management had guided. And if we just go down more, we understand that the management has revised the guidance on the higher side, that they have revised it to the range of 8.5% to 9% for the full year, which is very encouraging, which shows that the underlying sales and the TCV that the company is getting is there is no problem in that, and I think this should have been because of the BFSI revival, and overall, I think it's a good set of numbers.
Right. Vineeta, I was just a little bit surprised by the upward revision of guidance as well, considering so far the company was working with 6 to 8%. And now, as we approach the final quarter, it's been up to 8.5 to 9%. What are those factors do you think that has led the company to up their guidance?
See, last time I understand the TCV that the management had given, management had clearly stated that they have certain shorter tenure, revenues also which will convert. So maybe, this time around we need to understand from kind of TCVs deal values have been added. Maybe there are certain more of those numbers which have a short convertibility, which take. Because till last quarter, was maintained around 6 to 8% year on year, and at the end of the quarter, when the top line is very much well within the range of this kind of upgrade comes, that certainly means that some short duration tenure deals have been cracked by the management.
Right, Vineeta, hold that thought. Let me get in Amit Chandra of HDFC Securities as well. Amit, we were talking about TCS and the reason why we saw a contraction in margins yesterday. Today we've had earnings from Infosys. Even if I remove that 441 odd crore one-off with respect to Panaya Kava, we're still looking at your EBIT margins coming in at around 22.6%, which according to my estimates, it's still a bit tad lower. Are those headwinds also playing out for Infosys?
Yeah, so as we have clearly mentioned, the supply side concerns are visible for both Infosys and TCS. But in case of Infosys, if I adjust the depreciation, the amortization impact of 0.4%, then the operating margin comes to around 23%, which is well in the guided range of 20 to 24%. So I don't think that that is a real worry for the company. So the most important and the encouraging part for Infosys is that they have upped the guidance and the growth that they have demonstrated in constant currency in a seasonally weak quarter, and the large deal TCVs that they have reported 1.5 billion plus. That is really encouraging, and this shows the robust deal environment in the US, the revival in BFSI, and everything is working well for them as of now. Yeah.
All right, Amit. Again, I've been asking some of the other analysts here as well about the possible reasons behind their upping their guidance and by quite a margin. What do you think is the reason behind this?
Yeah, so if you see the large deal wins for Infosys, so it used to be in the range of $700 million like TCV. So the last 2 quarters they have reported around 1.5 billion and $2 billion TCV, and again in this quarter $1.5 billion TCV. So that is an indicator that the growth for Infosys is to accelerate, and also the other trend that is coming up is that the average duration of the TCV win is coming down. So because of shorter duration projects, so the revenue realization increases. So that's the reason why that they have increased the guidance, as far as my understanding goes.
Okay, and Amit, what are you keeping an eye on once the management comes in and speaks to its investors?
Yeah, so we will look at the
who else do we?
Vertical-wise commentary, as in which verticals they are seeing the growth coming in. Specifically in the retail, where they mentioned some kind of leakages in revenue and some kind of client-specific issues in retail. So that we have to, look forward to. And obviously, their reasons for the, increase in guidance that what they're seeing, and obviously on the margins front. So whether they will sacrifice margins to accelerate growth, because we have been seeing that the companies are reporting higher large deal wins. That requires a lot of investment in sales and marketing also.
Right.
So that you have to sacrifice on your operating margins a bit.
Right. So fair enough. Amit, just hold that thought. Let me just extend that question to Harit as well, if he's here with us. Harit, what are you keeping an eye on as we move into the presser?
Yeah, so I think clearly, the kind of commentary in terms of key verticals, mainly financial services and retail, given that she had maintained a fairly positive outlook last quarter, that is of course point number one. I wouldn't, be too, won't closely watch any comments as far as macro issues are concerned, or maybe Brexit, because those are in any case, well known, and those risks are there right now. So more importantly, the kind of traction he's seeing with his clients, the underlying business momentum that clearly seems to be on an improving growth trajectory. As Amit said, the kind of deal wins excess of 1 billion in each of the last 3 quarters. I think that pretty much, in fact, last quarter was 2 billion. So that pretty much reflects the momentum that is being witnessed right now.
Okay, and Vineeta, to you too, and if you could actually also add your comment on the possibility how you're seeing or expecting cross-currency movements to pan out for the company.
See, regarding what we will be trying to learn from the management through his commentary would be, one is the kind of problems they have been facing due to higher subcontracting costs to meet the supply constraints in many of the business opportunities. Also, the attrition has been higher for quite some time, and this time around we have seen the attritions have declined. Now it's very important, because that will, what kind of strategy the management is going to implant in, because that will be the main driver through which the EBIT margins will be guided going forward. Because we have seen, there have been attritions in the 3 to 5 year experience band. People and management guided last time around that that will get down in the next 4 to 6 quarters. They'll try get it down. So maybe this would be a very big reason as to what kind of promotion or what kind of a hike they will be giving, which will keep the EBIT margins continuously on the lower side of the band that they have been talking about. So one is that. Second, what we'll be looking at, so financial services BFSI segment has improved, and there have been issues on the retail side. So
right.
I to just understand how the two divisions have been panning out.
Right. Vineeta, just give me a moment. Let me also get in Moshe Khatri of Wedbush Securities, who's joining us on the show. Moshe, thanks for joining in. Your initial take on the numbers. Well, we are clearly seeing a surprise with upping the guidance, because that is something that we were not expecting. And of course, with respect to the buyback, where again the price at which the buyback's being carried out is much higher than what the street was working with.
Yes, I would say that the message from both TCS and Infosys is that demand seems to be better than feared in a seasonally weak quarter in general. Obviously, you have some optics related to margins for both companies, but net, I would say the results so far have definitely been better than expected from both companies.
Yesterday we saw TCS management suggest that this contraction in margins for this particular quarter is just a blip. We've also seen a contraction in margins for Infosys, and I'm not talking about the part in which they have provided for Kava and Panaya. Even if you leave that out on an adjusted basis, there is still a little bit of contraction. Do you think this can turn around in the quarters to come and we can see better profitability come through?
Sure. So for TCS, it seems that it was more of a business decision, given the fact that demand kind of came back, seems to have been coming back stronger than expected. Therefore, management hiring year to date was 3 to 4 times stronger in terms of numbers year over year. And typically, if this is what you do, and you have to go out and hire lateral people, that will impact your margins. But then on a ongoing basis, if you're able to adjust your bench in a more normalized level, you can argue that margins will come back. I'm yet not sure exactly what happens at Infosys, whether it's the same situation or where they're investing in the business, or it's a pricing issue. But I'm assuming they're probably in the same shape as TCS in terms of the reasons why margins were down and compressed. And if this is the case, I think the industry will adjust gradually to that demand pattern that's coming up. Remember, during the past few years, a lot of companies in the space haven't really done what they've done in the past, which is, sustain a certain amount of people on their bench, and they have not been billed. They have not been billable. So a lot of these companies have been much more leaner. Therefore, that's why they're kind of got caught in this situation where demand accelerated and they just had to go out and accelerate hiring, and that typically impacts your margin, especially if you're using more subcontractors. So at this point, it doesn't seem to be a structural issue. It seems to be more of a business decision where these companies are coming out and saying, well, demand looks good, demand looks better than expected. Let's go out there, hire more aggressively, probably a bit more laterals, and then we'll adjust our bench, and margins will be adjusted as well.
Okay, fair enough. Then in that case, Moshe, what are you watching from the management? What do you want to know from them?
Sure. So tone will be important. Any sort of color on what's driving this demand, or maybe demand catch-up, I don't know what you want to call it. It is interesting because the largest player, Accenture, when they reported their November quarter, they were very cautious, and that actually hit their stock. You can argue that given the fact that Accenture's quarter ended in November, and November, and basically TCS and NC had another month to kind of look at demand, and they probably had a better feel on budget trends and the budget cycle, have been able to kind of adjust their tone and adjust their outlook accordingly. But you can also argue that when Accenture reported their quarter, which ended in November, that was during the peak of the macro volatility, and the market was getting hit, and they had to come out and sound very conservative and very cautious. So tone on demand, what's driving those demand trends, and how sustainable is this? Are they seeing any sort of signals from clients that there's some sort of a spending cutback, but we're not seeing that? So any color on that front is going to be important, and obviously what's driving the strength in BFSI, which is also a big deal here.
Okay, well, Moshe, we leave it at that. Thank you so much for joining us and taking us through your views on, what we've seen with respect to TCS when its earnings. I'm also going to thank our other experts, Amit Chandra, as well as Vineeta Sharma, for joining us and taking us through your views too. Of course, don't go anywhere. There's lots more lined up. We'll be back in just a bit with the Infosys press conference, where we will have the management speak to us. Stay tuned in.
Over 100 countries are reaching here. You ought to be there.